In today's video, we're going to be talking about all things pertaining to a mortgage. What is a mortgage payment? What does it consist of? When do you pay it? And how long does a mortgage last and how many years? So, this video is going to be very beneficial to you if you are a first-time home buyer, because I know many of you have a lot of questions. You may not know how the whole home buying process works. You don't know what a mortgage is, so this video is for you. But even if you're not a first-time home buyer, this video will be very educational and beneficial to you because it will help you to understand what a mortgage is and to help you make an informed decision in the home buying process. So let's go ahead and get started. But first, let me introduce myself. My name is Cherilyn.Williams, and I'm your local Chicagoland realtor, helping you build your dreams through real estate. And if you need any help with your real estate needs here in Chicagoland, please send me a direct message. My contact information is in the description below. And also, if you could please like and subscribe to my channel, not only does it support me, but it helps this information get out to other home buyers. Get into it. What is a mortgage? A mortgage is a loan that you are going to take out in order to buy a home. You will take this mortgage out with a bank, a financial institution, or a lender, and they will qualify you to see how much home you can afford and if you can actually get a mortgage. You will borrow money from the bank now for the home purchase, but over time, you will be repaying that loan back with interest, and usually that length of time will be either a 15-year loan or a 30-year loan. And it's going to be important that you speak with your lender to find out which loan term will be best for your needs and your financial situation. But I will cover it very briefly. With the 15-year loan, what's great about it is that you get a lower interest rate, but you will be paying that home off quicker. So you'll be paying that home off in 15 years instead of 30 years. And the benefit in this is that you will be paying the home down quicker, you will be gaining equity faster, but the downside of a 15-year loan term is that your mortgage payments are going to be higher. Now with a 30-year loan term, your interest rate may be a little bit higher than with a 15-year, but your mortgage payments are going to be lower. And the downside, of course, is that you're going to be paying this loan longer for 30 years, and you'll be paying more interest over that time as well. The most common loan term is a 30-year loan term because the monthly mortgage payments are lower. But like I said, you will need to speak with your lender to determine which loan term will be best for you. What makes a mortgage different from a personal loan is that your mortgage is going to be secured by the property that you purchase. So the bank is going to use your property as collateral in case you default on the loan, you can no longer make your payments, and the home goes into foreclosure. Now with a personal loan, there's nothing secured by anything. With a personal loan, the only thing that really can happen is that your credit score can take a major nosedive. Now, the great thing about getting a mortgage is that it makes home ownership more accessible to a homeowner. Because if we couldn't take out mortgages, guess what? We would have to make these large payments on homes full price cash. And many of us, or many people that I know, do not have hundreds of thousands of dollars sitting around in their banking accounts. So it would make buying a home very unaffordable, and many of us could not do it. So that's why we take out a mortgage, or we have a bank finance a home for us and we pay them back. In contrast, the downside of getting a mortgage is that it can become very stressful and overwhelming for you because you have to make a long commitment over 15 or 30 years that you're going to pay this debt back. And also, there are a lot of upfront costs when trying to apply for a mortgage. Plus, you'll also have to qualify for a mortgage, which means that you will have to have three main things in order to qualify. And those three things are: you're going to need an income, a good credit score, and you're also going to need a down payment, which can make qualifying for a home very challenging. In addition to those things, you will also need your W-2s, your bank statements, your pay stubs, any assets you may have, any alimony, child support, all of that. So getting qualified can be very time consuming and very overwhelming for many homeowners. But if you desire to be a homeowner, this is what you have to do. So how do you apply for a mortgage? The first thing you want to do is you want to speak to a lender, bank, or financial institution to qualify you. And they will tell you everything that they will need in order to assess if you would be able to qualify. So like I said, the three main things they're going to look at is your income, your credit score, and if you have money for a down payment. It's important to kind of have those things in order before you speak to a lender. So if your credit score is on the lower side, work on improving your credit score. If you have decent income, that's great. But if you need to improve your income by maybe getting a second job, do that. And also save up money for your down payment so you can be in the best standing possible before you go and speak to a lender. Now, an important thing that a lender is going to look at is your income and your debt. They're going to be comparing your income relative to your debt to see what you can qualify for. And we call this your debt to income ratio, or DTI. So what the lender is going to do, they're going to look at all of your debts that you have for your monthly payments. They're going to be looking at your car loan, if you have a student loan, if you have any credit cards, any alimony payments, child support, and they're going to look at the minimum monthly payment that you have on each of these things. And then they're going to compare it to your gross monthly income. So your gross monthly income is your income before taxes are taken out. Then they're going to take your debts and they're going to divide it by your gross monthly income in order to come up with a percentage to see if you can qualify for a home loan. So let's use this for example. Let's say that your total debts come up to a simple number of $600 per month and your gross monthly income per month is $3,000. They would take that $600 of your debt and they would divide it by your $3,000 of your gross monthly income. And that percentage will let them know if you are a good candidate to take out a home loan. So in this example, your debt to income ratio would be 20%. Now your lender wants your debt to income ratio to always fall below 45% and in some cases lower than 50%. So in this example with the 20%, you're in good standing to qualify for a home loan because your income exceeds your debt. Now, many first-time home buyers make the mistake in thinking that their monthly mortgage payment is just only going to consist of principal and interest. Now, the principal and the interest are the foundation of your monthly mortgage payments, and that will never change over the course of 15 or 30 years, which is great. But your monthly mortgage payments may also consist of your property taxes and your homeowner's insurance. Now, your property taxes and your homeowner's insurance will be kept in a special escrow account that your lender will pay for you on your behalf, which is great because that's one less thing you have to worry about. And the lender would prefer that you keep your property taxes and your homeowner's insurance in the special escrow account instead of you paying it yourself, because what if you don't pay it? Maybe you may not have the funds or you may forget, and they don't want that to happen. So that is why they will do that for you. Now, if you want to, if you are responsible enough, you can decide to pay your property taxes and your homeowner's insurance yourself when it's time to pay them at the end of the year or twice a year. All you have to do is inform your lender that you prefer not to have an escrow account and you want to pay those things yourself. By paying it yourself, your principal and interest every month will stay the same and you don't have to ever worry about your monthly mortgage payment going up. But of course, you have to be responsible and you have to make those payments on time. Now, another cost that could be tacked onto your monthly mortgage payment is PMI, or primary mortgage insurance. If you are a homeowner that you are putting less than 20% down on your home purchase, your lender will require that you carry PMI, or primary mortgage insurance, to protect the lender in case you default. This is not for you, it's only for your lender. But the great thing with PMI is that once you reach 20% equity in your home, the PMI can fall off the mortgage, or you can inform your lender that you are now at 20% and you want it removed. So that's the great thing. So just to review, if you are putting less than 20% down, you may also have primary mortgage insurance tacked on with your principal, interest, property taxes, and homeowner's insurance. But it does come off after a certain period of time. Now, there are many types of mortgages that you can get, but the two main types are a fixed rate mortgage and an adjustable rate mortgage. With a fixed rate mortgage, your mortgage payment will stay the same over the entire loan term. So that's your principal and your interest. And most homeowners prefer a fixed rate mortgage because it's consistent and it's stable and they always know what the payments are going to be. There is also the adjustable rate mortgage where the interest rate will fluctuate or adjust according to the market. Now, with an adjustable rate mortgage, you will have an initial lower interest rate, which will make the payment lower, but then after a certain number of years, that interest rate can change, so it can go up or down, and usually we all know that it's going to go up. But this could be a great way if somebody knows that they're going to get an increase in pay in their income over time. This may be a good option for you because you can have the lower interest rate. Also, if you are a person that you don't plan to make this your forever home, or you're only going to live there for maybe 5 years or less, an adjustable rate mortgage may be great for you, and especially if the interest rates are high right now in the real estate market, an adjustable rate mortgage may be great because you're going to start off with a lower interest rate, but by the time it hikes up, you'll already be moved away and gone before it does so. But you get to capitalize on that lower interest rate. So that's why an adjustable rate mortgage could be a good option for you as well. But most homeowners prefer a fixed rate because of the stability. But once again, you need to decide what's best for you and speak that over with your lender. So when do you make your first monthly mortgage payment once you become a homeowner? Well, typically you're going to make your first monthly mortgage payment on the first of every month. Pretty much like how you are doing right now as a renter. Most of you, I'm sure, are paying on the first of the month. But once you become a homeowner, what's really great once you close is that you don't have to make your first mortgage payment until the month after. So, for example, let's say that you close in April. You won't have to make a May mortgage payment. You don't have to make your first payment until June 1st, which is really great because it allows you as a first-time homeowner to really get acclimated to, or getting in your head the processing of that you'll be making future payments, and you can get your mind all set and ready for what's to come. Now, many new homeowners, when they first get into their home, they're feeling good about their mortgage payment, and then maybe a year later, they will get a letter or a statement in the mail from their lender stating that the mortgage is going to change and it's going to increase. And this throws a lot of homeowners off track. They start panicking. They start calling the tax office. They start calling their realtors, wondering what the heck is going on because I have a fixed rate mortgage. Why did my mortgage go up out of nowhere? But like I said earlier, you have to keep in mind that your property taxes and your homeowner's insurance can change over the years, and usually they go up. So be prepared for your mortgage payment to go up as well. So I hope this video has helped you to understand what a mortgage payment is and how does it all work. But be sure that you speak to a lender or a very knowledgeable realtor to help answer any questions that you may have. Thank you for watching. Smoking on that air, we can